Hello everyone. Let's start discussion on a very important topic, and it is a very important topic in the infrastructure financing in a perspective of lender. So create your brain has like a thinking of a project finance lender. Whenever the lender do the infrastructure financing, so how the lender will think what are the insights and actual infrastructure that lender will or need to be see. So in this video we are going to discuss some golden rule of the project finance, and we are looking one of the case studies, and then we do some lender mental models where we are looking at each model. So I have created for you guys total the six models that will definitely help you to how to think in a lender perspective while you are financing for infrastructure project. And then we are looking for the top three reasons lenders say no, and lender can say no to the sponsor or the off taker while looking and review their the entire projects. And think like a lender, what the three questions you need to keep in mind and the class exercise, and then we will do the key takeaway from this video, guys. So let's start discussion this video. So let's discuss on the agenda what we are going to look in this video. So before moving to the details in the agenda side, I would like to request you guys, if you are new to my channel and if you are interested in the role of the quant analyst, business analyst, credit risk analyst, market risk analyst, or the document writer, so please do like and subscribe my channel. So that's created me to create a new trending videos on this topic for you guys, which the market needs and highly demanded in the market. So that will definitely help you to upskill your skills and get a better opportunity in the market. So let's start discussion the agenda where we are going to look at the golden rule we lend to project, not a company. So first one, the project is 100 the megawatt solar park case study. So that's the one of the case study we are going to look. And then the lender six layer mental model. So six layer mental model where we are going to discuss each layer in detail with each slide specifically for that. Then we are going to discuss on the key metrics that is essential and important for the lender to do the debt service coverage ratio, loan life coverage ratio, project life coverage ratio, and what they really mean and why they are important for the lender and how they calculate it, what are the importance of that. Then we will look at the risk allocation, who take what risks and why they take the risks, what are the kinds of different kinds of risks in the project finance. So we will look these things. Then deal killers will look why lenders say no, and your turn how to underwrite like a lender. So how to underwrite like a lenders and your thinking ability should be like a lender. So let's discuss on the very important topic, guys, where we are going to discuss on the golden rule of the project finance. So there are the three golden rules that you need to keep in mind while you are going for the interview, while you are writing the project appraisal note. So we lend a cash flow, not a balance it. First one, we are lending the money on the basis of cash flow of that special purpose vehicle generated, not balance sheet of that project sponsor. We are not going to look at the balance sheet. We are going to specific fund. So they created the special purpose vehicle, SPV. They called it as an SPV. For it is an the specific entity. It is an the one of the organization that specifically managed and organized by the sponsor for that projects, for that project. So there is, suppose let's differentiate that thing, the corporate lend. The lender rely on company's overall balance sheet. If as a lender, if you are a lender and if you are giving a corporate lend to the corporates or the sponsor, that lend is the projects are rely on the balance sheet of the that loan borrower. So balance sheet of that borrower. So if it fails, the company pay from other businesses. If the corporate lend, the borrower will not able to repay the principal and the interest rate, so in that case the lender will collect from its balance sheet and different businesses collect his money. So that's the ability that lender will have. But the project finance loan lender rely only on projects cash flow, non recourse or limited recourse to sponsor. So project finance is only on rely on a project cash flows. Cash flow is the important thing for the project finance, and it is on the non-recourse finance, guys. You should understand what is the importance of the non recourse finance. It is and the most important concept, guys. So a non-recourse loan is a secured debt with lender recovery is limited strictly to the pledged collateral which is buy from that, and if the borrower default, unlike a recourse debt, lender cannot pursue the borrower other asset or personal income to cover any remaining balance. These default higher interest rate and due to the lender risk. So these are the different kinds of risk. Then therefore the lender job. So be paranoid, but every dollar in cash out for the 15 to 20 years. So that will be the lender. So it will be the long duration project. So it's the special purpose vehicle is created for the 20 to 30 years. Then the quick questions you should keep in mind as a lender. So if everything that can go wrong, what does go wrong, do I still repeat? I still repeat, I still get my money from that if everything goes wrong. So that's why we do the stress testing, scenario analysis, sensitivity analysis for that project, where we check is this thing, if the interest rate is increasing high, if the cost of raw material is increased for the 10%, if the operation and maintenance cost is increasing. So anything that is, to, or if some land acquisition is delay for 2 months, if there is a any major events, there is a natural disaster that we cannot predict, if there is a black swan event will happen. So what are the predictions, what are the things that will be utilized to overcome these things? So that's we are going to look, and that will spend the time. So let's move on the next slide, guys, where we are going to discuss on our case study, where we are going to discuss on the 100 megawatt solar park. It is on the most important case study, guys, if you think on the lender perspective. So the project shortfall, what one lender decks is look like, and what are the comes into the lender decks. So the parameters and the details we should, the location, the Maharashtra and India, it is on the one of the location for the 100 megawatt park, and the size of the 100 megawatt AC solar power will be generated. Okay, and the total cost of that project is a 40,000 crores. The cost is a huge for that project. And the debt and equity. So debt is the loans that take from the financial institutions, bank, NBFC, and the equity are the sponsor fund. So they the sponsor invested fund. So in that case, it is a 75 to 25%. So debt is a 30,000 and the equity is a 10,000 crore. So let's move on the next revenue contract. So 2-year power purchase agreement with the MSEDLC. They make a 2-year power purchase agreement, which is on the government body. They buy the power, the off taker. So or the that contract will happen with the off taker. Off taker is the government body, or the off taker is a party that typically a business utility, a government entity. It is and the government entity that enter into the contract to purchase or use a significant portion of produce future good or services and electricity, raw material, and agriculture product. These long-term direct purchase agreement provide a critical revenue certainty for the financing project. So the MSEDLC is the off-taker for this project, and the P90 generation will happen there. So that's the things is there. And then the 180 gigawatt per year electricity is a generated there. So that's the calculate, you can yourself calculate how much the revenue will generated from that project. And the construction 12 months fixed price EPC with LDs. Some LDs you need to go read that LDs. You need to understand that LDs, how, what are the LDs as an analyst. If you are the analyst or if you are the lenders, so you need to understand that what are the LDs are mentioned in that. So that's the fixed price. And then the takes us so 18-year tenure, 9.5% interest, and the culprit is the repayment. So that's thing is there. So let's move on the next slide, guys, where we are going to discuss on the lender mental model. Let's start discussion on the each lender mental model, where we are discussing on the cash is king. Then second we are discuss on the debt service coverage ratio, heartbeat, then the risk allocation, then the security package, then the live in the downside, Then we are going to discuss the tail and the tenure, what the data things. So let's move on. The question, the three questions lender asks first. So revenue category, is the PPA sign? You can check, is the power purchase agreement is a sign by the sponsor or the government authority or the off taker, like the Solar Energy Corporation of India Limited, like that way they are signed. Okay, then the second one is MSDLC is their sign. If that okay, then is MSLDC is a credit worthy. If whichever they make a agreement, it is a credit worthy, they will rely on that thing. It is a government institute that we check. And then we check a payment track record in the past, what their payment track record is, they deliver, do the payment on time, delay, how much delay they will happen in future, how much delay we are going to expect. So that all these things we study step by step and add that thing in the scenario analysis or in the sensitivity analysis or in the test testing. So we are going to able, so how much the risks in that thing. And then is there the LC, letter of credit, and the state guarantee is there. Then the resource risk, so the solar has no fuel cost, so but it can't be guaranteed, so we need to check. So it the resource that need to be to generate that thing, so solar has no the fuel cost, so it can't be guaranteed. We size a depth for P19, not a P50. P90 means a 99% probability case. So P99 means the 99, P99 for the probability of the 99%. So cost certainty. So let's are the operation and maintenance cost is what? Is there the insurance, land lease, fix, or the floating? How they lease the land? They will buy the land, lease the land. So different state has different mechanism for the land related things. And then we stress operation and maintenance 20 plus years in our model, so that will be look there. And be, but contracted predicted cash is inferior for these kind of things. So let's move on the next slide, guys, where we are going to discuss on the second lender model, which is the debt service coverage ratio is a heartbeat for this project. So the formula of debt service coverage ratio is a cash flow available for the debt and the debt services. What are the debt need to be services? So we also call that the CFADS, cash flow available for the debt service, where where how much the revenue that the project will generate it, that figure we have on the basis of the power or the capacity or the construction side or the generated or the mechanism, mathematical mechanism we use. And then we calculate the revenue, how much they generated, then what are the apex tax and all these things they have, then the tax they will fix, and the capex for the maintenance or other things that need to be paid before the debt service available for the cash flow available for the debt service. So that will calculate it. And then we will calculate the principal. Debt service means the principal and the interest rate that need to be paid for the lender. So if that is the more than 1.10 or 1.20, so it is a better. If for the yearly basis, so debt service coverage ratio we will calculate it on the yearly basis, and the loan life coverage ratio we will calculate at the on the total life of that project. So project life, so entire life, loan life coverage ratio we calculate it on that basis. So let's move on the for this solar projects is a 2 year PKs. So in case the revenue is a 59 crore and the apex is 8 crore, cash flow available for the debt service is a 51 crore, and the debt service is a 40 crore. So we minus the 51 crore minus 8 and the 59. So revenue, so we will minus, and then we will do the 1.2x. So which is a good revenue. So we can take as a good debt service ratio, but we need to calculate it year on year basis and then average it. So average debt service ratio is also we calculated. And then we will do the lender rule. So minimum covenants is a 1.2x usually. Below this the default 1.2x is a below, then we consider as a default, and the base case is a P90. So won't be a the greater than 1.25 or the 1.35 for the solar. So that will be the good, and this will be considered as an accepted project. And that thing we also check a terms and condition and norms that defined by the Reserve Bank of India. So let's discuss on the LLCR, loan life coverage ratio, which is the one of the most important ratio that we has a analyst or has a lender, we need to calculate it, we need to analyze that thing. So the formula for the loan life coverage ratio is a PV of cash flow available for the debt service over the loan life divided by the debt. That will be total principal and interest rate that will be issued by the lender for that lives, and it will be, and it won't be the less than, or it will be the more than the 1.30x. So that's the the second the debt service heartbeat. So let's move on the next slide, guys, where we are going to discuss on the lender mental model, and it is on the third side. It is a risk allocation, where we are going to discuss on the risks, who take it, and how the lender is protected. So let's discuss on the different kinds of risks. First one is the completion risks, off-taker risks, resource risks, technology risks, and the political risks. So the completion risks we will do for the EPC contractor plus the sponsor, where we are discuss on the how the lender is projected. So in the EPC contractor and the sponsor or the operation and maintenance contractor, if we do the fixed price, date certain EPC, liquidation damages, sponsor completion, we do the milestone project or the date on which the each milestone is achieved, and that basis the payment, the disbursement will happen. So and the fixed price project, so that will be the good for the completion risks on the operation and the EPC contractor. Then off taker risks for the lender plus a sponsor. So 25 years who take the lender and the sponsor take, correct. So the 25 years power purchase agreement, 1 month later of credit, state government, we still check receivable days and how the lender is protected. So there is a power purchase agreement, 1 month later of credit, government guarantee, that need to be checked, that need to verify, to check the covenants of that thing, to check the laws causes for that thing while before lending the funds. Then the resource non-resource risks, non-resource risks. So it is on the lender risk. So lender will take that risk, and it is the date size on P90 energy, probability of 90 energy, independent energy yield assessment required to do the data analysis. What are the recourses? What are the things that need to be done? So that need to be done by the lender side. Then the technology risks. So these risks is on the bucket of the supplier and the sponsor. So the sponsor and supplier will be defined, and that automatically comes under lender because of the cost of that project is increases. So the burden of to pay the debt to that project is increased. So it's every risk is in the bucket of the lender directly or indirectly. So if but it is a fixed term contract, the fixed price contract, so that's it's not come under the lender, but it is a variable. So that might be definitely impact on the bucket or the loan size of the lender. So the tier 1 model, 25 years performance warranty, independence engineering sign off. Then the political risk share, so change in low protection in the PPA, but retroactive policy change is equal to over risk. So let's move on the next slide, guys, where we are going to discuss on the fourth lender model security. So that is the security package. So we lend non-recourse. So collateral is our plan B. Let's just keep in mind, guys, you are going to lend for the non-recourse. So the collateral is our plan B. It is not a plan A. So what lender take has a security? First charge on all the project assets, land, plant, machinery, and bank accounts. So the first charge, the first owner of that, all the project assets like land, plant, machinery, and the bank accounts will be owned by the lender. So first of the the owner is a lender. If he receive debt and the he receive principal and interest whatever he charge, so he is not the owner of that thing. If the any risks happen, in that case they are the first charge. Then the assessment of contract, right to stay in PPA, EPC, operation and maintenance if sponsor default. So has a analyst or has a if you are working in infrastructure project, so you should be able to the things and understand the power purchase agreement, EPC contract, operation and maintenance, and the power sponsor. So you need to read that all these things and get summarized document. So project appraisal document. So that need to you need to show your the senior management. So you should have that level of understanding. And then the trust and retention account where the cash water flow lender paid before the equity get divided, so the trust and retention account is maintained. And then the reserve account, so it is under one of the important. There is a different types of account, we are going to look at these things, but the reserve account where we call as a debt service reserve account, so where the 6 months debt services will be stored, how much the principal and the interest will calculated for the 6 months for the that date, so that will be stored in that account. If any uncertain event is happen, and in that case this project sponsor are not able to pay the interest rate and the principal, so they will collect from that account. And then operation and maintenance reserve for is equal to 3 months ops and funded on the day one. So that thing is there. So let's move on the next slide where we are going to discuss on the lender mental model. So it is on the five live the fifth, and the live in the wide downside, the live in the downside. So where we are going on the different scenarios, what we change, the result for our projects, and the lender decisions taken by that thing. So let's discuss on the banking base case. So P90 generation on time commercial operation date. Okay, COD stand for the commercial operation date. So basically the commercial operation date in that case, on which day that project is completed and that electricity is generated, and that will be utilized by the end user who pay for that thing, and that as per the PPA agreement that will be sell that electricity to the Solar Energy Corporation of India Limited, and in our case that is the uh, MSEDLC. So we shall that for them, and then it is approved. So in such cases, we will approve the things. Let's move on the next, guys. So COD delay. So 6 months delay or the LD receipts. So that will be the check. So 6 months delay, the commercial operation date. So in that case, the different cost is increasing. 6 months, the cost revenue is generated zero. Think like that, guys. Revenue is generated zero, but the construction cost, operation and maintenance cost, or the land acquisition cost, different kinds of cost is there that will be generated, and that will be the 6 months. So that will be, DSCR in that case is reduced, and that will be the 1.5%. Right, but okay, sponsor support. Once the sponsor support, they are ready to add more equity diffusion. So then we can take that he has forward. Then the revenue streams. Off-taker pay 3 months late annually. If suppose you do the analysis as an analyst, you understand that take the off-taker, the government body who signed the power purchase agreement and to buy the output of that product or output of that project, and they may pay the 3 month annually. So in that case your debt service coverage ratio will reduce to 1.28 to the 1.05. So it is a breaches 1.20 and need more debt service reserve account and the equity, and you need to increase the duration of to stay the principal and interest rate in the debt service account and add more equity from the project sponsor and the apex shocks. So model replacement year 12, and then the operation and maintenance plus 40%. Loan life coverage ratio drops to 1.22x. So fail need to capex the reserve. So that's thing we need to gather in that thing. So let's discuss on the last the lender mental model. It is a six, the tail and the tenure, where we are going to discuss why we don't lead of the full PPA life. So why we are not don't lead the full PPA life? Because there is a perpetuity comes in that sense, and we are not able to calculate, there is no end date. So how we are going to calculate the how much the principal and how much the interest rate we are going to charge? So the PPA life is a 25 years, so itself the PPA year that state that, and the debt tenure is a 18 years. So tail period is a 7 years. So the tail period is the period where the debt tenure minus the loan life, the PPA life minus the debt tenure. So we will get the tail. So PPA life minus the debt tenure. So why the lender demand a tail? So why the lender want the demol? Because they want to the recover that thing. So restructuring time, if project underperformance in a year 15, so we have 7 year of cash flow to restructuring loan, refinancing operation, healthy tail improve chance of refinancing later, cause and cover the delay in enforcement. We if we need to take over the project, so that thing is there. And the rule of thumb is a minimum 2 to 3 year tail, no tail, no deal. There is a minimum 2 to 3. So if there is a no tail, there is a no deal. Simple thing is there. So we want to, as a sponsor, as a lender, we want to back our money. It is our job. It is our analysis. It is our thinking ability to back our money. So let's move on the next slide, guys, where we are going to discuss the top three reasons. Okay, for that the lenders say no to the sponsor. So the deal killer we see every week. So deal killer every week. Weak optaker and the weak structure. It is and the most important thing, guys. If there is a power purchase agreement happen between the sponsor and the any second third party intermediary, and they want to buy something, and they're the historical things, and they're the balance sheet and all these things, while we are doing the analysis, that shows they are not good, and they are not the covenants, they are not follow their covenants, and they are not able to repay, and that project has not the futures, and that project has the environmental impact on that thing. So in discoms we 200 plus delays receive on no payment security, debt service coverage ratio need to be greater than 1.50 to be compensate such thing. Then the aggressive assumptions, while you are reviewing all the documents that provided by this project sponsor, so and the power purchase agreement or the concession agreement or the loan, the different the operation and maintenance agreement, or the EPC engineering procurement consultant construction agreement, while we are going to that thing, and the cost of that project. So you should understand while reading that thing, it is the aggressive assumption, or it is a genuinely or relying on that data, or relying on that thing past performance, so that the assumption is correct. So date choice on the P15 solar, or the 20-year date for the 25 years PPA, no reserve using the hope has the mitigation. So that assumption, how much the revenue that generated, how much the traffic that generated, so understand that things will be the important. Then the sponsor has no skin in the game. So the let's understand, if the sponsor has no skin in the game, it is on the most important concept, guys. If the sponsor are not able to invest their more amount, so that is the sponsor has no skin in the game. So sponsor want 85% debt and the 50% equity. So he is the rely on the more on the debt side, and the less investment from his pocket. So it is a, and the key reasons. So we need to maintain the debt service ratio. We need to maintain the debt to equity ratio. Sorry, guys, and no completion support. If they can walk away without a pain, we will lend holding the bag. So that thing will there. So let's discuss on the next slide. The think like a lender, three questions to ask yourself. So your mind, your brain should work in the lender perspective, guys. Because why it is important? So in a infrastructure finance industry, the funds that you are going to lend for the infrastructure projects like a road construction, rail construction, sport constructions, or the port construction, airport construction, or the water management, or the resource management, this kind of project, that funds is comes from the bond market, where the that funds is invested in the pension fund, or the insurance fund, or the different kind of the intermediary that invested in that funds. So that fund, some might be invested by some person who are invested in the pension or the insurance. for the looking of their child education, for their hospitality coverage. That way that fund is come. So you need to take care of that thing, and you need to make sure that we need to back that fund to the saver, because why they are saving? Because they are building the economy. So that's why they are saving. So before you send a term sheet as yourself, so where do I lose to sleep? Let's list top three risks: construction delay, off-taker payment, model aggregations. If you can't sleep, neither can if we eat it, and you should stay on and very focus on that thing. Show me the cash flow that break it. So show me the cash flow, check their entire cash flow, that special purpose vehicle. Don't give fee 50, give the fee 19, probability of 19, probability of 99%. So it is not rely on the probability of 50. So probability of 90 or probability of 99%. Or breach cases, then show how to cut debt service reserve account, sponsor infusion and insurance, what that you need to take. Then what happen on day one of default? If you start defaulting on the day one, so what happened? Can we step in who run the plan in their the 6 months cash flow, their result to give the time on the fix? So that we need to check. Then we are going to take class exercise. So you are the lender, what do you do? So if you are lender, what do you do in that case? So I'll give you one of the case, guys, and below the give me the answer. So I'm very happy to go on your the write down the notes, draw down the ski notes. So scenario is a 100 megawatt solar project in 3 years, and same off taker is MSDL, payment for by 4 months, and debt service coverage ratio has been fallen 1.5, and current is fallen for the 1.28. So data you have debt service reserve account for the debt service is a 3 crore, and the sponsor is large listed company, you need to listed company, and the technical performance is a probably of 90%. So discuss in a group what is the technical default or the payment defaults will happen, what is the first action as a lender you will take, what is the first action as a lender you will check and do in that case, and how would you accelerate the loan or the restructure that thing, and what are the mitigation strategy you are going in that case. So let's move on the next slide. It is the key takeaway from this slide, guys, where we are going to discuss how the lender think on the slide, and how the thinking ability a lender will build. So key takeaway from cash flow is everything in the infrastructure financing. It is created for the special purpose vehicle. The loan we will give on the non-recourse to the sponsor. There is a power purchase agreement will happen probably at 90% is reason. So the we are the ring face the loan will happen, so that will be turned on the cash flows. Then the debt service coverage ratio is a plus it is a greater than 1.2x, and the spation is a critical we live in a downside cases, or the risk allocation is greater than the risk taking. Everything risk must sit with someone who can manage it or mitigate it. Security is a plan B, so we need to have the securities which we are going to discuss. All these securities, it's a plan B. We want to project to work collateral, and we could comfort it. We as the lender has we are not competing with the bank, because in the infrastructure finance we are not going to compete with the bank. We are the participant, we are the friends of each other. We are going to Indian economic or the Indian infrastructure, and the paranoid optimist, we want to say yes, but we underline assuming say we will know. So that's the end of the interesting seminar, guys. If you do that thing, you will definitely understand the thinking like a project lender. So your thinking ability will increase in the perspective of the project lender. Thank you so much, guys, for attending this interesting seminar. And I'm very happy to teach you that the topmost syllabus or the topmost topic. Once again, guys, thank you so much for attending this interesting seminar. And I would like to request you, please do more hard study and get the better opportunity in the market in the infrastructure side. Thank you so much, guys.